So, Elon Musk's AI empire is really a tale of two companies. You've got Tesla, the massive public company everyone knows, with a valuation that's completely banking on a future built on AI and robots. But then there's xAI, his private, super fast moving AI startup. And for anyone watching, the big puzzle is how do these two actually connect, and where is the real value being built? This really is the heart of the matter. If Tesla is the AI powerhouse its stock price suggests it is, why on earth is a totally separate, privately owned company building what's supposed to be the most powerful AI supercomputer in the world? It's a contradiction, right? So let's dig into both sides of this. Okay, first, you have to understand the story Tesla tells the world. For years, the whole pitch has been that it's not just a car company. No, it's a leader in what they call physical AI, the idea of solving real-world problems with robots and autonomous software. And look, this isn't just some marketing line. Musk himself put it out there plain as day back in January 2024. He basically said that if he didn't get 25% voting control, he'd rather just build these AI products outside of Tesla. You could say this statement pretty much set the stage for the entire conflict we're seeing now. This physical AI narrative is absolutely everything. It's the rocket fuel that has kept Tesla's valuation in the stratosphere, leagues above any traditional car company. So for shareholders, this story isn't just some nice idea about the future, it's the bedrock of their entire investment. So that's the public story. But now, let's talk about the other player that's suddenly appeared on the scene. Right when Tesla is supposed to be making this huge AI push, a new private company pops up, xAI. xAI was founded in March 2023 with this grand cosmic mission to, understand the nature of the universe. But in practice, its job is to build cutting-edge AI, like its chatbot Grok, which puts it in direct competition with the biggest names out there, like OpenAI and Google. And if you need a visual for how ambitious xAI is, just look at this. These are not the pipes for some small-time operation. This is the massive cooling system for a supercomputer they're calling Colossus. And the key thing to remember is that this enormous piece of infrastructure is being built at lightning speed inside a private company, away from the eyes of the public market. Let's just put these two side by side for a second, because the difference is, well, it's stark. You've got Tesla, the public company which just retired its own custom AI chip project, Dojo. Now they're shifting to GPUs. And on the other side, the private company, xAI, is building this monster Colossus with a target of more than 200,000 of the best NVIDIA GPUs, claiming it'll be the biggest in the world. The gap in scale and ambition is just massive. So the obvious question pops up. How are these two connected? Well, it turns out there's a pretty clear bridge of resources, and it seems to be flowing from the public company to the private one. Probably the most famous example of this is the chip diversion. An internal NVIDIA memo reported by CNBC showed that a huge shipment of highly coveted H100 GPUs was rerouted. They were supposed to go to Tesla, but instead they were sent to X and xAI. The result? Tesla's own AI hardware plans got delayed by months. And just so we're clear, we're not talking about a small rounding error here. The estimated value of those diverted chips was over $500 million. That's a huge amount of computing power that Tesla's public shareholders probably thought was coming their way. Now, the official explanation from Musk was pretty direct. He said Tesla's facility wasn't ready for the chips anyway, so they would have just been sitting in a warehouse collecting dust. He presented it as a simple, logical choice to get expensive equipment working instead of letting it sit idle. But the connections between these two companies go way beyond just those chips. Shareholder lawsuits are now alleging a whole pattern of resource sharing. First, there's the talent. Key engineers from Tesla's super important autopilot team were recruited over to xAI. Then there's data. xAI was supposedly given access to Tesla's valuable proprietary AI data. And finally, the big one, capital. Tesla itself invested $2 billion of shareholder money straight into xAI. So, when you have this steady flow of resources, chips, talent, data, and cash, moving from a public company to a private one, both led by the same person, well, it was only a matter of time before it caused a conflict. Tesla's shareholders definitely noticed, and they decided to take action. A lawsuit filed by a group of shareholders lays out some pretty serious claims. They are accusing Musk of breaching his duty to Tesla. They point directly to the diversion of chips, talent, and data, arguing that it was all done to build up his private company, xAI, and that it happened at the direct expense of Tesla and its investors. The defense, on the other hand, paints a totally different picture. They argue that the chip diversion was just a temporary, practical move. They claim that the synergies between Tesla's real-world AI and xAI's digital AI will ultimately benefit everybody, and that the $2 billion investment, that just makes the collaboration official. So this all boils down to the core debate, the billion-dollar question. Is this a healthy, symbiotic relationship that's going to help Tesla reach its goals faster? Or is this a siphon, draining valuable resources from public shareholders into a private venture? And to really get why this matters so much right now, you have to look at the timing. All of this is unfolding just as Tesla's main business, actually selling cars, is facing more competition and pressure than ever before. I mean, the data really tells the story here. Just look at this trend. Tesla's automotive gross margins peaked at over 29% back in 2022. That's how much profit they were making on each car. But since then, price cuts and heavy competition have really squeezed those numbers down. So here's the bottom line. As making a profit from selling cars gets harder, that AI story becomes more critical than ever. It's the narrative that justifies a tech company valuation, not a car company valuation. The pressure to deliver on that AI promise is unbelievably high. Which brings us right back to these two competing arguments. The synergy side says that partnering with a nimble private AI company is the fastest way for Tesla to win. But the siphon side argues that value that should belong to Tesla, its people, its data, its money, is being used to build a completely separate private empire. And that $2 billion investment is really the perfect example of this whole mess. Just think about it for a second. Tesla's shareholders are now, through their own company, funding the very startup that they're suing their CEO for creating, alleging he used their company's resources to build it in the first place. It's a pretty wild feedback loop. Ultimately, this whole situation forces us all to ask a much bigger, more fundamental question about how modern corporations work. When one person is in charge of both a public company and a private company with goals that overlap this much, where does the value truly belong? The answer to that is going to decide who really profits in the end.